Hi, everyone. Hope everyone had a decent turnaround Tuesday. Everyone doing okay? What wild markets, especially S&Ps. So if you could trade them, I tip my hat off to you. I mean, look at this action. All in one candle, giving most of it back today. Same with the yen, which was a turnaround Tuesday candidate. Both this was worked, this was worked, and now we're testing out to see if yesterday was real. Are we going to get another high in gold, or are we going to get this? That's the question. Same in silver. Silver outperforming gold again. Gold silver ratio. Dixie, to me, this could be a sale. Pretty weak bounce. I thought we'd get more. 720. Thought maybe we'd head up towards 98, 98.20. But that's a pretty weak rally when you think about it. Hardly able to recover anything. I may look to short it because I do think we're going to 95.5. So here's the picture on it. I think these dollar bulls are trapped for this cycle, so they're not going to let them out. Figured maybe we could go 98. Anyway, yesterday I knew what to do. I had some ideas after yesterday's action, and in fact there was no follow through, and we're trying to just negate everything, especially in the S&Ps. It's tougher. Someone put a gun to my head, I'd short the dollar right here, and I might be taking a chance at maybe a failing rally. See kind of off numbers we have here. Off number in silver for today is 1705. So that's a possibility. Silver has a little stronger look to it than gold. Yeah. 1520. Aussie hasn't made a new low. Of course, it's getting hammered. Maybe we get this. We'll see if we're going to get a new low in Aussie. I would think that if the dollar is heading down, that there might be something to do here on the long side of Aussie, maybe down here risking the lows, but I haven't done anything yet. And then crude had a really holding up the best. I know it's given back some, but you start looking at crude and tough to be short. This bottom pick from last week is still intact. So, every once in a while, and it's not easy to admit still after all this time. Yesterday I had a few ideas, and let's talk about this for a second, okay? So say, for example, you bought 1 yen yesterday when we were talking about it. And I said, we really need to clear some highs here. I was talking about this high, I think it was 530. We went almost to 107. So say you caught a good piece of that. All right. And then we were trading about 1525 or so in the gold. Maybe you didn't ride it all the way down. Maybe you rode it to 1500 and you made 25 bucks. Do I really need to know what to do today after a day like that? Okay, so in the olden days, I would think, yeah, I want to keep trading. I'm in the zone, right? Hi, Elena. But you know what? How many trades a week like that, even a month, do you need to have a successful account? And then something else, I used to hear myself think, hello, Shahab and Ite. Well, it's the house's money. Merry Christmas, Zig. It's the house's money. So, you know what? It's not the house's money. It's mine now. And I'm going to protect it like it's mine. So you figure, oh, you could be a little sloppy for a while and it's okay if you give some back. No, you still need to have a reason to do something and not just trade because you're up. Write that down. I don't have to trade just because I had a few winners if I don't see anything. I had a good week yesterday. It's okay to do nothing. So far, that's what I'm doing. And that's why I'm with the team that I'm with, because you know what? I'll make this bet that these guys have some ideas what to do today. So if I don't know what to do, I could just go and say, hear Amanda say hello. And then I could look at what the active pattern and plays are. If I wanted an idea, I could go to all the recent research for any of these pairs and look for confluence. There's pretty good agreement on the long side of Aussie Kiwi. Boy, that was tough last week to catch. 2 central bank meetings. One caused a washout to new lows, and the other one caused an explosion. Okay. A lot of mixed views here. So you know what? I don't see a lot of confluence or, like, 3 greens or 3 reds here throughout all of these. So, and the fact that there's only 3 active patterns in play tell me that maybe there's a reason why I'm not seeing anything, because you know what? If these guys, this team is not seeing a lot to do, there's not a lot to do. Okay. So, and when you find yourself scanning, looking for this, it's okay to just sit back and see the forest from the trees. And a good day to call Forest Park to see the forest from the trees. And look into setting up another account so you get a rebate check or have our subscription paid for. Or a great day to do some research and have some major areas in mind in case we do get there. So preparation doesn't always mean that you're trading. We're preparing and waiting for something compelling. So I have nothing compelling that's really saying, Dale, I have to click the mouse. I'm wondering what Blake is thinking here. How are you, buddy?
Good. It's just, the bond market obviously is we've
Yeah.
seen a really, really strong move once again in bonds. And I thought the bond market might have seen the highs, but yields continue to fall. And we've seen a lot of moves
They didn't do much. They didn't really firm up much with that, one candle, 30-second, 50 handle move in the S&P yesterday.
No, they didn't. But I thought they were gonna, maybe start to show some signs of weakness. But that's just that has not been the case. We've seen, the dollar yen came down here. Let me go ahead and
okay, buddy.
Take the charts. I was looking at the dollar yen a little bit earlier like this. I was looking at it like a
Right.
little pennant. But we slumped through support and we hit the 618, and I went long at 80 just because we were at the 618, so I figured I'd try to be on the long side, just like a counter trend trade. But I'm really surprised how weak the bond market is and yields. So if you take a look at yields, let's take a look at like the 10-year. Here's a 10-year yield. You see how yields have come down quite aggressively, and
3 years even.
Oh yeah, I mean, you look at the 2-year, and that it's like inverting pretty good, and we're seeing just yields come off pretty aggressively, and I'm was thinking that we'd get a bigger sell off in the dollar yen, and the dollar yen has come down, but I'm surprised that the dollar yen isn't trading down, down at 105, 50. And that's why I picked it up, because I was like, okay, yields are really breaking lower. Dollar yen's kind of holding in there. So I picked it up at, just that little divergence. That doesn't mean that we're going to get this, get a real big bounce. I'm almost, hold on really quick. Wilbur Ross says tariff delay to avoid disrupting Christmas season. So that no quid pro quo from China amid U.S. dollar decision. So he's just saying that China's not responding to the U.S. being a little bit more lenient about the tariff. So that's just he's basically saying it's gonna get uglier. Oh man, not good, not good. I don't know if I really want to be long this dollar yen anymore. Let me sit here and look at it for a little bit.
Well, President Trump saved Christmas after he was the one that
He's
hated,
trying.
but he's the one that caused the problem. So he saved Christmas from himself.
Yeah, that's of
What do you think?
course. Yeah, I mean, he's creating problems.
Good morning, guys.
Hey, vacation man.
I hope my voice comes through clear because I'm obviously in a hotel. That I just want to say, having to do with what you just mentioned, it's really funny because Trump was trying to persuade everybody that tariffs are not affecting the U.S. consumer and they're being paid by the Chinese.
Right.
But at the same time, he's now using as an argument that he doesn't want to burden people ahead of the Christmas season. So which of the two is it? Of course, it's a
depends
rhetorical.
on the what time of day it is. You're in a tunnel.
Yeah, I mean, but he's got a poor internet connection from where he's at, so he's just.
It sounds good. Yeah. What do you think, Blake?
Well, yeah,
it's both.
I'm sorry, I'm focused on my dollar yen.
Okay.
Yeah, obviously these. He says no date set between the U.S. and China in September.
Yeah.
So Ross is moving the market a little bit right now. That's why I'm just kind of trying to pay close attention here. I'm surprised yields haven't fallen any further. So bonds have kind of stalled, which is interesting. The euro dollar's getting a little bit of a lift here.
Guys,
yeah, hey, go ahead, Stelios.
Hey, sorry. While you do your
no. Yeah,
I just have a couple of things to say. I think what we're seeing is Donald Trump is, as usual, he's been using his shock and awe tactics, and he's announcing tariffs and left, right, and center. And I think most likely, he's not a stupid person, right? He has advisors. They're probably realizing that the consumer this is gonna hurt the U.S. consumer going into the Christmas period, and it's gonna destabilize things a little bit. So I think that's probably the reason why this is now being delayed. And just like Wilbur Ross said, there's no quid pro quo. So basically, the Americans they said we're going to slap on these tariffs. Now they're taking them off. Well, the Chinese are sitting there saying, "Okay, what's your next move?" So
right, yeah. So what else are you going to do for us? Because I'm not doing anything else from here. Basically, is what China. China's not scratching our back. And they're probably. I mean, think about like the Chinese. They're like, right now they're going. I'm watching you guys self-destruct at the moment, right?
Yeah. Was it Napoleon who said never interrupt an enemy when he's self-destructing or harming himself or something like that? Somebody said that. Maybe I've got it completely wrong, but it's the right thing to do.
Right. I mean, China's just taking a step back and saying, let's see what else they're gonna do here. What else the U.S. might do. So it's interesting. This is the especially when you what was Donald Trump's books negotiating, what was like King of Negotiating or whatever his bestseller is. I forget what it is. But anyway, I'm sorry, I'm just kind of keeping an eye on the yen here, just making sure it doesn't get too crazy. Steve, while you're here, and let's say you have a little bit more internet bandwidth, do you have any other thoughts before, we let you go. I'll run the charts. Don't worry about that. But just
first of all, I hope you can hear me better now. I just plugged in my AirPods as well, so I hope you can hear me better.
Oh,
Yeah,
we
we
can.
can hear
Yeah, you sound great.
Okay, perfect. Yeah, I had another thought that isn't really focused on China, Blake. We see today all the headlines because, you know, I do pay attention to the headlines. They are always behind the curve, but it's interesting to see what the reporters are sending out there as, you know, what the market supposedly is focusing on, etc. So I've got, despite being on vacation, I've got like several headlines coming through today, all of them focusing, once again, it's like it happened suddenly overnight, on the yield curve and what kind of ominous signs it sends for the US, UK economy, etc. So my general thought about it is that, you know, volatility, the more the days pass, the more the weeks pass, even if we don't, you know, directly go in a bear market, which probably we won't. I mean, they will still try to do everything and anything possible to postpone the inevitable until the end of next year due to the US presidential elections. And, you know, the UK, for example, for the same reason, but, you know, they want to postpone it, but not for the same reason, because they don't want, you know, a recession to come in along with Brexit. I do think that volatility is going to keep expanding on average. And I do think that more interesting times are ahead. I'm pretty sure about that.
Yeah, well, which is good for us. We're probably going to be,
Absolutely.
when you say interesting, it's more volatility is probably what we're looking at as traders. So that's you know, could be a good thing for all of us. Now, you've probably seen this move since you were gone. You've seen this move in gold over the last couple sessions. You know, we hit the 161% extension of the. Well, this is the you know, this move lower is 161% extension of like the range of the last 3 years. And we're really just kind of hitting the lows from back here in 2011, 2012. So what do you make of this move in gold? Because I think a lot of people are really itching to short gold up here while we're below this, you know, 1535. What's your take here? Because we've had such a massive move in gold.
Actually, Blake, you made the point for me. I would feel much easier looking for at least, you know, a corrective move lower if I didn't see people everywhere trying to fade it. I mean, what troubles me, I know that positioning now is gold is reaching extreme, at least having to do, you know, with the recent past. I know that we've hit some extension targets. I know that we're overbought. All of those are valid arguments. But I still don't see the bears to have capitulated. You know what I mean? I think that the people that are trying to fight this move higher first need to capitulate before we probably see a deeper correction lower.
Yeah, and I'd agree with that. What I'd probably prefer to do in this type of scenario is wait for a little bit of a correction in gold. Now, I don't think gold's going to correct a whole lot from where we're currently at. I wouldn't be surprised if we might have corrected all we're going to correct yesterday. The move down below 1500 and maybe this 14. Because you can see this right here is a pretty good indication of it. This little false breakdown below the 1490 level, that may have been it. And if I had to guess, gold's probably going to do something like this and consolidate its recent gains and make another move, probably higher. That would be my initial thought.
It is very likely. Yesterday's candle, which was an outside spinning top, is a candidate for a reversal. But I would want to see a lot more to be convinced about it. Until that happens, your theory about a likely horizontal consolidation before moving higher is the higher probability scenario, in my opinion.
Yeah.
So I would agree with you.
Yeah, I mean that's the way I'm thinking about it now, which You know, if you're trading gold and you're like, okay, well, I do want to short it because I know we're up against key resistance. I think what you've got to look for is very small gains. You know, you got to take just little bits and pieces when you can get them. Sorry, I'm going to take a look at this dollar yen here.
100% I agree with what you said, because two things are certain. One, fighting the trend so far has proved to be painful for the people that are trying to do it, and until we get more evidence is extremely dangerous. But on the other hand, gold has already made a big move higher after breaking out. So chasing it up here for longer term positions without seeing a healthy correction lower first makes no sense, at least not from a risk reward.
Yeah, no, I agree.
I agree as well, guys. And I just wanted to add, I look at the weekly charts on gold and silver, and the 1535 level that you have correctly said, Blake, is huge. I actually have a zone like 1535 to 1550. And the amazing thing with gold is that it's a huge vacuum after that, up to like the high 1700s, literally. And then after that, it's all-time high. So when that breaks, or when that breaks, it's just gonna explode even higher.
Yeah, and I agree with you. This right here is what I've long viewed as, you know, this just resistance zone. 1535 to roughly 1570. And yes, if we break above that, I mean, and you can see I've got it marked up to the 618 retracement, which would be 1580 roughly. Yeah, we get above that, and there is this, it could take us from, you know, about another 130 points higher in gold. So you got to be real careful about being on the short side of gold. I do agree that, you know, intraday or, you know, from a swing trade perspective, it doesn't make sense to be long now. But I'm hoping that we get a nice little consolidation over the next few weeks until we come into fall and really see what the direction is going to be following into the fall, because I actually think that there's going to be higher levels for gold moving forward. And if you look at and just so we, you know, are all clear here, this is an inverted head and shoulder pattern, big inverted head and shoulder pattern. Whoops. And that, okay, if I can grab the line here. I can't. Trying. Let's
right click on it. There's a chance that you might have locked it.
Yeah.
By the way, thank you, Ziggy and Stavro. It was Napoleon who said, never interrupt your enemy while he's making a mistake.
So if you look at like the inverted head and shoulder pattern, it points to 1700. I mean, it points to 1720, you know, roughly, depends where the neckline you're drawing it from, 1720 to 1730. I mean, so we have a long way to travel here in gold still. We're only about halfway through this rally on what we can really expect technically. Again, we're not going to go there. We're not going there today. But, you know, if you're trading it on the short side, you've got to think what the longer term targets for bulls are right now. And it may not be all-time highs up here at 1900, but we still have some distance to move. So great. I'm glad we had an opportunity to talk a little bit about gold. Let's discuss real quick, Stelios, while you're here, this move in bonds. How do you make, what do you make of this move higher in the bond market? I mean, we've seen boons. I tried to fade, and by the way, just so you guys know, I tried to fade the bond market overnight. I put in a quick stop. I don't trade boons necessarily, but I put in a pattern in play just to try to sell it at the 161% extension. It just continued to rip higher. You can see we're seeing a little bit of reversal right now, but I tried to short the bond market and got stopped out really quick on that. It was a small loss, but I still, you know, got run over. What do you make of this move in the bond market?
Well, it is a crazy move. What I think is the bond market is basically telling us that there is a global recession coming, which I don't disagree with that, you know, because the way things have been going in the major economies, they've been turning lower, and it makes sense. having said that, if I look at it with a long-term view, I think yields, negative yields, bonds at minus 0.6 or whatever it is, and Treasury is the 160, so that's still yielding a little bit. But if I look at it with a long-term view, I think it's probably not a bad place to start shorting bonds. Like myself, I tend to accumulate positions with a long time frame, like a few years down the road. If you close your eyes today, you sell some bonds now, and you go 2 years forward, you're probably going to be quite nicely up. But the question is what happens in between. And we know that the markets, they can tend to overextend.
The other question is how many people how many people said the same thing 3-4 years ago?
Absolutely. I've been sitting on my hands saying, bonds are too expensive for over a year now, and I haven't done anything yet. But at some point I will, and because we have to remember the markets always tend to overextend, especially when there's panic. There's nothing seems to be good in the global economy these days. Trade wars, local problems like Italy and Hong Kong and China and German economy. Well, the GDP was negative today, the print. So we get one more. We're in technical recession. So the bond market is, I always say, is right, but it does tend to overreact. And I do think we're getting to these levels where we're starting to really overreact to this, to the global situation. Can bonds go higher? Of course they can. They can go much higher, but.
All right, very good. Well, we don't have any data coming out today, so what I'd like to do is I'd like to cover some of these majors, and let's take a real quick look at the euro dollar. So, I've been trying to play the euro on the long side. Yesterday, I took it off because when the euro came under pressure yesterday, I took it off for a loss. I was long some, and then it came down. I'm like, okay, I don't want to be long that right now, and not until we get above this 112. Well, now it's like 112.25, and I am actually leaving it alone for now. Was trading a little heavier today. I'm still, unless the euro gets above 112.25, I'm just gonna kind of leave it alone right now. But I'm actually quite surprised that the euro isn't a little stronger with the risk off that we've been seeing. Come on, dollar yen. I want the dollar yen to trade back above 106. I'm going to move my stops up to break even here in a moment if that happens. But anyway, the euro I'm just kind of leaving alone for right now. I really don't want to deal with it at this moment unless we start to see that bull flag take shape. The cable, Stelios, I was actually pretty optimistic that the pound was going to try to make a move above 121. Then Boris Johnson opened his yap this morning and basically said that the EU is not budging, and it's just another indication that we're walking closer to the edge here. He's taken the UK closer to the edge. What do you think about this whole Brexit situation?
Well, first of all, we had the CPI number today. It was 2.1%, so higher than expected and slightly above the target. Remember, CPI is at, let's say, at 2%. Average earnings growth is 3.7%. These are not bad numbers. Unemployment is low. Of course, unemployment is a lagging indicator. But what I think is, we saw Boris Johnson today, and he said that basically the EU is being too stubborn. And, I've thought about it a little bit, and I think it's, first of all, is a change to what Theresa May had been doing for the past years, in that she had effectively taken away the possibility of a no-deal Brexit, or at least she wanted to avoid that. She wanted to take it off the table, and she'd always said that. Now, Boris Johnson comes a little bit more unpredictable as a character, and he says, look, we're coming out of the EU on the 31st of October, no matter what. Right. Now, it's up to you to make compromise to the EU, just like the UK is going to make some compromise, and we have to find a solution. This is different to what the Europeans have been hearing for years now. So if they're going to do something, because so far, they, up to this point, they were just sitting there saying, look, you're taking the no-deal Brexit scenario off the table. We have nothing to lose. We're just going to sit here and wait. So now it's up to them. And I think if there was ever any possibility of some kind of deal, good deal, bad deal, I don't know, this is probably the way to get it. So
I agree with you, although I'm not very optimistic.
Yeah, I know you've said
Yeah,
that.
maybe he's like the negotiating master. We'll find out. Right? We're going to find out by October 31st.
You know something, Blake. What is important though is what Stelios said. They have nothing else to lose.
Yes.
I'm very uncertain that this is going to work because for several reasons, I think that the EU doesn't want to show any leniency. But I would agree that if they have some chance of getting something, some kind of compromise, this is the way to get it. So they have nothing to lose.
Right.
Yep.
No. Your comments about the EU. I mean, the EU has to take this stance, and if you're the European Union, you're going to make it literally impossible for a country to leave the EU. Meaning, they're using the UK as an example right now. So it's going to be really interesting to watch this all unfold by October 31st, because if the UK walks away without a deal, the pound probably will trade closer to parity to the dollar, or maybe 110, maybe 105, who knows, somewhere in that realm of possibility. But if the EU at the last moment comes with some sort of compromise, the pound could trade up to 140. The one thing that I am looking forward to this fall is there's going to be a really great opportunity, any which way you slice it, in the cable. Any which way we look at it, it's going to be pretty awesome. I hope.
I agree 100%, and I think it's not a wish, but I think as a trading opportunity, a no-deal Brexit with an exaggerated, because I'm pretty sure we're going to see an exaggerated reaction from the FX market to that, is going to be a magnificent, at least medium-term buying opportunity for pound against probably everything.
Well, and I'm not even opposed to finding the pound, finding a bottom wherever that might be in the cable. If there is a no deal Brexit and the pound does slump to, I don't know what the prices are. I mean, we can speculate here. If we take the cable, and let's just go on a weekly chart. We'll go historically. What we've had. You could go from, let's say, the low of 01, right, to the high here in God, that was 2007. I can't believe that was that long ago. I mean, the 127% extension comes in at 115. Scary thing is the 161% extension comes in at 90. That would be crazy. But
you have another 161.8 though there, very interesting, at 104.
Oh yeah. This one, and that's just from the last few years.
That's a nice level.
Yeah, I mean maybe 104 is it. So we'll see. I think there's the risk is that we start seeing some of those levels, and I've tried to stay away from the cable for the most part, because I am a little worried about being on the long side, without having any concrete deal. So, when I look at the euro pound, it's like I tried to short it last week, had some tight stops, got stopped out, real, no harm, no foul. But man, trying to play the cable on the long side right now is a very dangerous game. And frankly, we haven't seen anything technically that even gives me an indication that I should be buying. And I was thinking, hey, if we can get above 121.05, I was thinking about buying some cable this morning. But then, like I said, Boris Johnson turned that ship around real quick. Didn't give us anything to cling on to. Let's take a real quick look at the Aussie. Aussie trades heavy, and so does the Kiwi. Both of these are trading heavy, even following the China-U.S. news. China, as we had pointed out, they are not making any concessions. As Wilbur Ross pointed out, there's nothing coming from China's side. So, the Aussie just continues to trade extremely heavy here. And, I know a lot of people are out there looking at the Aussie and trying to be long, but I'm going to tell you guys, while we're below this 68.30 to 68.50 level, there is no reason, in my opinion, to be long the Aussie US dollar. Can you trade the Aussie long against maybe some other currencies? Perhaps. I think you could maybe venture out to do that here and there, but trying to trade the Aussie dollar on the long side, it's a fool's game right now while you're below this support. We have to get back above that support, which is it's resistance, but previous support. We have to get back above that in order for me to even consider about being long the Aussie dollar, and that's probably would be more related to the China news. I mean, you even saw yesterday the positive news from what we thought was positive news from China didn't even get the Aussie dollar to sustain a break above 68 cents. We just came right back down again. Kiwi dollar is very similar. The Kiwi dollar trades very heavy, and again, this is one of those things where you have a central bank that's possibly going to be moving to zero. What's the reasoning here to be long New Zealand dollar? Unless it's some positive, extremely positive China news, I don't think there's any reason to be long the Kiwi either. The dollar Canadian, the dollar Canadian's been in this channel, and I've actually been watching the lower end of this channel. Yesterday we tried to push below 132, we couldn't sustain, and we just ripped right back up again. As long as we're above this channel support on a closing basis, no reason to be on the short side. We are testing the 200-day moving average, which comes in at 133. All right, and that is the high for today, is 133, at least for right now. And just realize that there is, the 200-day moving average is sitting right up there. So, being long right now doesn't make a whole lot of sense. But at the same time, I don't know if I really want to be on the short side. I've kind of left the Canadian dollar alone recently. It's been not that readable of a pair to trade, so for me, I've been just kind of staying away. I'm going to go take a real quick look at the dollar yen really fast. I'm still long some dollar yen. My stops I just already moved up to break even, but really we have to get a move back above 106 for me to even feel comfortable about being long the dollar yen right now. The dollar yen is just kind of floundering around. It looks heavy. Bond yields are still heavy. Bonds are still extremely strong. And while the bond market continues to stay strong, there's no reason to be, I'm not convinced that the dollar yen is going to be ripping up, back up to 106.50 or anything like that. Like I said, my stops are break even, so I can kind of stand aside now. But let's look at some of these other yen pairs. The euro yen, while we are below 120, there isn't a whole lot of reason to be long the euro yen. We're kind of floating around this previous 2019 lows. We hit a new trend low or new yearly low, bounce back. Not sure if we're going to get a false breakdown or not, but I'm going to tell you right now, this resistance zone, you can see it comes in right at 120. While we're below 120, what's the reason to be long here? Now, if the euro yen breaks above 120, that might be a different story. But for right now, that's not the case. And I think that you've got to continue to, think on the short side of this while we're below 120 at least. Sorry, I'm just taking a look. I'm going to take a real quick look at equities really fast. I'll come back to the rest of the yen pairs because they all are going to be moving in similar fashion. So here's equities. What a disaster. Coach, I don't know if you're here, if you're listening in, but he said it pretty good when he first came on. Good luck trading the S&P.
I'm here, bro.
Yeah, I mean, your comments when you came on, at the very beginning this morning, you're like, "Good luck trading the S&P." I mean, look at this, look at these moves. What I mean, the I'm gonna just take a step back for a second and just realize kind of what we're doing. We're really stalling at the 618. So we had a big sell-off, traded below the 200-day moving average, bounce back. We're at the 618, but we have not been able to sustain any type of rally beyond that. So yesterday,
it's not just the candles, bro. It's the way the candles are formed, like in 30 seconds.
yeah,
Like yesterday. And then it closes good yesterday, and then you go to sleep and you wake up and it's giving it all back. How can you hold a position?
Yeah, it's near impossible right now.
Only Steve Volge could.
There are very few people out there.
Yeah, he's got the stomach for it.
Yeah,
you know, as you've said many times, I'm too old for that.
No, I mean when you have a hernia and your intestines keep pushing outside of your stomach, it's like you can't. How can you
Never
deal
had
with
one of those.
Me neither. But if you trade the S&P, you're probably going to get one sooner or later.
In your wallet anyway, hernia.
Right. So let me ask you this. We got about 20 minutes left before you bring on your guest. Who's your guest today, by the way?
His name's Tavi, and he's
It's Peter Schiff. I'm kidding.
No.
Oh no, yeah, Peter Schiff. Tavi Costa.
Okay.
And he's with a firm called Kretzcat. So I believe they're registered investment advisors. And
Got it. Okay, so you have your guest coming on in about 15, 20 minutes. Let me ask if anybody has any questions on any specific pairs they want me to take a look at. I will. And because it's not like I'm always here for an hour and I can spend time looking at things that you want to see. So if you have any questions, Coach, just keep an eye on some of the questions and any pairs that people want to take a look at. But real quick, as far as the S&P goes, I think this is this to me will define what we should be doing here. And let me also state that we are in August, and it's nice that we're seeing volatility. That's a good thing. Volatility is, I think we're blessed right now for getting the volatility that we are getting. But it is August. That also means to me that we're probably not going to get a major breakout or breakdown in the market right now. And if you remember my comments from back when we were selling off, last week or whatever it was, when we were coming under pressure, my opinion was at that point in time that we were going to do something like this. And then into the fall, we're going to make a more decisive move. I still feel that way. So what does that mean? Well, what that means is unless there is something specifically that comes out that whether it's a concrete evidence that a China trade deal is getting done or one that's not going to be done no matter what, like it's like all bets are off type of thing. Unless that happens, we're probably going to be in some sort of consolidation between now and September. Now, does that mean that the S&P can't, violate this range? No, we might end up being in a range that looks like this. We might be in a range that looks like this. But what I'm trying to point out here is that try not to get too directional this time of year when we're in August. And also, going back to what Coach was just saying a little while ago, is that you probably need to be a little careful with holding positions overnight. You can see how they quickly reverse, out there. So you just be a little careful. I'd probably be more apt to just, you got some profits, take them off the table. If you have some gains, at least move your stops to break even, take a little off and see if the rest will run. But, be a little bit more conscious about holding those positions, not holding those positions overnight, I guess is the point that I'm trying to make. And I think we're going to be consolidating probably for the next couple of weeks as we head into
got a
fall.
couple of requests if you want to take them.
Yeah, let's do it.
Bursk in chat room wants to short USD ZAR. I'm assuming that's USD ZAR.
The South African Rand, yeah. So, you know, the Rand, you know, this is one of those, and matter of fact, I haven't looked at this currency pair in a while. Keep in mind that the South African Rand is one of those, you know, emerging market currencies. So because it's emerging market currencies, if risk deteriorates, then the risk of it moving higher is high, okay? But if we do end up consolidating, like let's say, you know, stocks are down, you know, you take the S&P down 1.5% this morning and we bounce back and we're only down 0.5%. Well, chances are the US dollar South African Rand is going to sell off. Now, Andre is going to be popping in here tomorrow. He's our in-house harmonics expert, you know. So if you're looking at, you know, the harmonic chart patterns here, you're going to get them from Andre. Now, I'm going to just tell you by you know, eyeballing the South African Rand right now, I actually see a nice Gartley pattern developed, and now I'll point it out. Right, take the high, low. There's A, B, C, and then 127% extension probably takes us right about where we're at. Right, that would be 88%. Or close to. So here's the thing: if you want to short the South African Rand, the US dollar South African Rand right now, I think your risk is minimal, meaning it's manageable. So if I was going to trade it now, it's not saying that I'm going to, because I don't trade the Rand often. I tend to trade the peso more. What I'd probably do is that if I was going to short it, I wouldn't risk more than today's highs. Because this is a 618, you can see how we're respecting the 618 retracement right there. So I think if I was going to do it, which I'm, like I said, it's not something that I'm keen to, but if I was going to do it, I would just not risk above this high. And I think you have a manageable risk reward, but you don't want to get it, you know, don't want it to get it too much higher than where it currently is. Or too much lower than where it currently is, because then your risk reward is pretty skewed. Because like I'm talking like, let's say you enter right now, and let's say you're just targeting. Let me get rid of that really fast. Let's say you're targeting trend lows right here, right? So right now, if you enter here, your stops are here, your target is somewhere down here. You're risking 1 to make 2, and if you get really lucky, you know, and let's say, you know, the stock market turns higher because China and US call some sort of trade truce through the end of the year, and it looks like they're going to resume talks in September. Then it pushes down towards 14.9. Then you get a little bit of a home run there, right? So, I think the risk reward's there. It's obviously counter trend, but if you like I said, from a risk reward perspective, I think you can take a shot. You know, just keep your stops tight. Don't because, you know, if things progressively get worse and we see things break down between China, US, Brexit, you name it, whatever the, you know, all host of things that could go wrong right now, a confidence vote in Italy, blah, 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 blah. Next thing you know, the South African Rand is trading above 1550. So you don't want to be stuck in a situation where, you know, these emerging market currencies continue to squeeze even further.
Euro Swiss?
Yeah, Euro Swiss. This is a currency pair I have not taken a look at for a long time. So let's take a real quick look. And let's go ahead and let me take a little bit bigger view here. All right, so you know what? We just finished. I've obviously drawn this a long time ago. It's not something I've looked at in any recent time. So we had this double top played out, right? Double top, or range. I like to call it a range extension. So that range extension basically played out, and we have hit it. Now, the question is, now that we've completed this range extension that you see here, the question is, are we going to get a bounce? And the problem that I see is that you've had, you know, a week and a half of basically consolidating down here. You got a little bit of a reaction the first day that we hit that range extension, which would have been right here, right?
Mhm.
So that first day, you did get a reaction, you got a bounce, and now here we are back at those lows. Now, so that to me tells me that there's a bit of a problem, and then you start thinking about, okay, well, what's the issue with the Euro Swiss? Well, probably Italy, I would assume. You have some support down here at 108 and a quarter. I mean, if you wanted to play counter trend, right? If you wanted to play on the long side right now, the risk is, I think, below this 108 and a quarter. And the flip side of that is if we break through 108 and a quarter and you're like, no, I just really want to be short. I think if you break below 108 and a quarter, then you get a gap fill down here that takes us down towards, 106 or basically 107. So, if you want to play it in the direction of the trend, I think you just have to be careful of that support that's just below, and if it breaks through the support, then that's probably your green light that we've got some more weakness coming. So there you go, dollar Swiss or Euro Swiss, excuse me.
Okay, how about I'm not sure if you covered guppy, Euro CAD.
I did not. Let me take a real quick look at the pound yen. So the pound yen it's like the euro yen. It just continues to trade heavy. We here's the pound yen. Sorry, we trade below this 130.65 level. That was the previous 2019 low. Next target comes in at 127.67. Despite being oversold, despite the divergent relative strength, there is absolutely no reason, in my opinion, to be long the pound yen, the guppy. Unless we get above, 130.65, the risk, in my opinion, is a continuation lower, at least to this 125. Let's just call it 125.50. It was 125.67, but that's the price that'd be the target that I'm looking for. And frankly, if we can, and I'm going to just use the trend line here on the relative strength. If we can make it to this new low, right, and relative strength sells off, yet we don't make a new low in RSI, I would actually consider, being on the long side down there. If that happens, if we hit this level, relative strength does not hit a new low, then I would consider being long. It'll be interesting to see, because if we do hit a new trend low, there is also a risk that, Coach knows what I'm talking about here. There's a risk that relative strength might actually hit a brief new low, which would then confirm that this downtrend is for real. So, being long the guppy down here, yeah, it's just realize that it's the pound, and you're dealing with not only Brexit, but you're also dealing with firecracker Boris Johnson. So there you go. And do you have anything you want to add there to the guppy there, Coach?
No, not really.
Okay. Now you just asked about the Euro CAD. Let's take a quick look at the Euro Canadian. I played the Euro Canadian quite a bit from the long side when we were down here, and unfortunately I missed this entire move. So this move, the spike higher, which I was waiting for, I missed. I think I got long down here, got out, took some profits, then I got stopped out for a loss. I got chopped up around here, and I was literally waiting for this move, and I missed it. I wasn't around for that entire move. Now, if you look at the Euro Canadian and you kind of think about it from a longer term perspective, the reason why I was playing it on the long side down there was that I knew that a trend line was just below, so I just kept playing it on the long side, chopped around finally just said, I'm not even going to deal with it. And then, you know, I missed the move. What do you do with it right now? Well, I mean, I guess while we remain below this trend line, being on the long side doesn't make a whole lot of sense. And if you are in the camp that stocks are going to continuously go down from where we're currently at, which I don't necessarily think is the case. At least it hasn't been proved to us, excuse me, that that's the situation. Then the Euro Canadian, on a risk aversion type of move, the Euro Canadian is best played to the long side. So that means it's eventually going to break higher. That's how I would play it. But if you go back to what I was just saying about the rest of the month of August, we may be in a consolidation period in the stock market before we see bigger moves this fall, which I think is the case. So what I would be probably thinking at this point, if I was going to trade the Euro Canadian, which matter of fact may come back on my radar, is if we head back down here towards like the 46.50 level, and we head back down there, I'd be more apt to play the long side down here then look to play a breakout over here. If things get worse, equities come under severe pressure, the Euro Canadian is one that I would trade alongside. That's the Euro Canadian, Euro New Zealand, Euro Aussie. Those are all pairs that, as you guys know, last week I played the Euro New Zealand alongside. By the way, I sold the Euro New Zealand yesterday at 174 and change. I sold it up here before this move. Just so you guys know, I think I sold it up here up on the spike, but I was out of it when that news hit. I didn't have it, and frankly I had an order to buy the Euro New Zealand at 72 cents or 172, excuse me. I was looking for this. If you were a ForexAnalytix subscriber, you had this chart. I was looking for a dip down to 172 to get long. I actually still have a bid out at 171.92 that never got triggered overnight. So, but I'm more likely to trade the Euro New Zealand, Euro Canadian, and the Euro Aussie to the long side under periods of risk aversion. So unfortunately, I'm not long any of them right now. All right.
Thank you for your coverage today, Blake.
It's my pleasure. And guys, tomorrow I'll be here with you. I thought Steve was going to be here today, and it was kind of late that he did pop in, and he was able to come in today. Tomorrow, if you're here, I'm going to go through the analysis of. I'm going to do the bias chart for you guys tomorrow. Paul Franco is going to be No, I'm sorry. Andre is going to be joining us tomorrow. So I'm going to go through the bias chart tomorrow. So this way Steve doesn't even have to worry about popping in tomorrow morning. And I'm going to do the bias chart and get you guys all up to snuff on all the majors first thing in the morning tomorrow morning. So one last thing I wanted to mention before I turn it back over to Coach. Hey guys, if you haven't contacted Forest Park FX, our webinar sponsor, please do so. They will help you as a retail trader find a broker that best is suited for your needs. If you're more of a long-term trader, what brokerage firms might offer you a better rate or less of a ding on your margin if you hold positions overnight, versus if you're more of an active trader and you're looking for tighter spreads, what broker is going to be best suited for your needs. Make sure you reach out to Forest Park FX, and if you want to be part of the ForexAnalytix community, possibly for free, you can join the reimbursement program with ForexAnalytix, and you can find that right on our website. And this also gets you to Forest Park FX, because if you contact them via Skype or this email, it's going to go directly to them. So guys, thank you very much. Coach, I'm going to turn it back over to you.
You could just leave it right where it is, bro, and I got it. And thank you so much. Good hunting today, Blake.
Thanks, guys. Hey, have a great one. I appreciate you all being here with me, and I'll see you tomorrow morning.
Okay,
Thank you,
Blake
Blake.
Morrow,
Thanks,
everybody.
Stelios. Thanks, Coach.
Stelios Contos, my best friend at ForexAnalytix. All
Love
right,
you, bro.
All right, Tavi, I'm looking forward to meeting you and promoting you to panelists right now. And looking, let's see, make sure that I have you unmuted. And I know you're going to bring some charts that you want to talk about, and really a pleasure to meet you, Tavi. I hear your guitar. So if you just hover your mouse over the drop-down menu, you'll see a green box that says share, and you click that, and then you could show the screen you want to show, and waiting to hear your mic. Hope you have a mic. I hear something going on over there. Tavi?
Hello.
Hi, Tavi. I heard you say hello. Hello, Tavi. Tavi, can you hear me? Live TV. And then you just scroll your mouse or whatever over the drop-down menu, and you'll see a green box that says share, and you click that, and then it'll give you a screen for you to share. And I'm still waiting to hear your voice. I hear some pounding, and I heard you say hello. I'm curious what's happening with you. Bob, you want to send me a question in the chat so I know what's going on with you?
I think I can hear you. Can you hear me?
Oh, I can now, yeah.
Okay, perfect. Do you want me to turn on the video or no?
No, as I said, you don't have to show your webcam, but you can share your screen. There's a green box that says share, and you click that,
Mm-hmm.
and then you choose which screen you want to share.
Gotcha. Let's see here. So now
Okay.
you're seeing
Okay, we got it.
okay, and if I want to pause to share right there, so now
Okay, so we're looking at commodities to S&P 500 ratio.
correct. And then how do I, let's say I pause, I click pause share, so you're not being able to see anymore, right?
You don't have to pause it. You know, you just keep it on share and you change the screen. So
Gotcha.
let's get past these technical issues here.
Yeah.
You're good to go.
I think I am. I think
Yeah,
I
you are. Now you're showing the 3- and 5-year yields.
Yes.
Okay, so let's start with this, Tavi. I read a little bit about your bio.
Yeah.
And you were, what, born and raised in Brazil?
Correct.
Okay, and educated in St. Louis?
Correct.
Is that correct? So tell us a little bit about your journey and how you ended up being a money manager, advisor. I'm assuming Crescat is a registered investment advisor. Am I correct?
Yes, you're correct. Yes, we're
Okay.
a hedge fund.
Tell us how you got from point A to B.
Okay, so I moved here to the U.S. about 10 years ago, right in the midst of the whole financial crisis in 08 or so, and then I came here to go to college. I was playing tennis, and I was recruited to play tennis in college here in Virginia at Liberty University, and then I moved to St. Louis to finish up college, and moved to Denver later on, and that's where I started my journey at Crescat Capital. And at Crescat, I really started as a kind of covering more of the emerging market side of things, and then moved on to global macro, and really helped to build not just the systematic models that we use to develop themes in general, but also a few of the narratives of investing themes that we've used throughout the years. One of them being China, a major one. And then that kind of moved on from there. And now I'm a global macro analyst, and I manage the portfolio alongside with Kevin Smith. Or our team is investment team is mostly both of us really and making the decisions and so it's been quite the journey, but I've enjoyed a lot of this work in general.
Okay, I would just assume, having grown up in Brazil and surrounding countries around there, that you would have been pretty interested in currencies, the way they change colors in Argentina. You lived through some defaults, Brazil, the real going through devaluations, etc. So we just lost your screen.
Oh, sorry.
Do you still have an interest, or did you have an interest in wanting to know how to protect yourself from devaluation of fiat, having grown up in an environment like that?
Absolutely. I mean, it's actually an interesting culture shock coming to the U.S. and seeing people that don't necessarily have lived through inflationary periods. And I lived through that for a long, long time. And any person who lived in South America had that issue. And Brazil was actually not as bad as other places in terms of getting to a hyperinflation, unless you're talking about the 90s, which I was really young, and but I remember my dad, struggling. He had a business at the time, and I think he bought a motorcycle once, not exactly on because he wanted to, but it was just a way of hiding from inflation. It was that bad, and I remember he made a great profit on that trade.
Okay.
But that's how insane inflate those periods were in Brazil. Yeah. And now
it's like the story of the Weimar Republic, right? You had a wheelbarrow full of Reichsmarks, and people would dump out the currency and steal the wheelbarrow.
Correct. Yeah. I mean, and investors in Brazil have been, very kind of a cherry on this entire, stock market in Brazil that continues to go higher. But, one of the best investments in Brazil has been just gold, just hold gold and in real terms. And you've done phenomenally well. So, I still think that that's kind of the case, especially what's happening in China. I think that, it's kind of hard to not see a scenario where China devalues significantly and the Brazilian real or the dollar in real terms doesn't go up as high as 5 or 6, on an exchange rate. So it's, I think that that's all a very, very likely scenario to occur.
So you want to start off talking about rates and negative yielding investments and what's happening here with possible yield curve inversion, and you go ahead and tell us what you're thinking at Crescat and how you're positioning your portfolio to take advantage of what you're seeing.
Yeah, I'm happy to go through a few things. I have here a few of our macro themes as well. I can, anyways, I'm happy to talk about them as we go, and whenever you want to stop me, I'll
okay.
Elaborate on whatever.
All right. Count on it.
Okay, sounds great. So, at Crescat now we have 3 high conviction themes, and one of them being the U.S., which we think it's more of a distortion of prices, asset prices in general, not just stocks, but corporate bonds and private equity deals in general are extremely overvalued, and even real estate, depending on the place, relative to fundamentals and some macro indicators as well. So that has been sort of one of the themes that we've been implementing in the portfolio by shorting the most overvalued U.S. equities. Then China.
What would they be? FANGs?
Some of them are FANGs. A lot of them are software stocks that have been. I think I've tweeted this a few days ago about a few software stocks being trading, medium software application software stocks now trading at 73 times free cash flow. And, that's just that's just the median. You can look at the basket and just look at the most overvalued ones. There's some, companies trading at very similar multiples than things like Beyond Meat. And some of them are actually legit companies. It's just like it goes to show how difficult it is for you today to find a good business with a good model. And any company that today has some sort of, let's say, subscription model with top line growth, Wall Street is valuing them at absurd levels. And there's very low cost to carry to short those positions, and those have been one of the major, I guess, places where we've been focusing on. It's a very expensive pocket of the market. There are more, that's not the FANG stocks are also, the Netflix of the world, and all those are also. But we use a quant model at Crascat that scores 1,000 stocks and globally. And so we search for the ones that have the lowest scores in that in those metrics of valuation and others of in general. And then we usually select a basket of those and hold them as we go. And and part of the investment process here is that if those scores start to rise, obviously that gives us attention, and we go back and see if we would like to still hold those positions on the short end, and if not, we can always swap with something else that is scoring bad. So that has been a way of for us of selecting a basket of the what we think are the worst.
How do you manage risk on short positions?
Well, we manage risk on a CVAR basis mostly, but obviously there's different ways. This is just one of the processes that we use is just bucketing or risk in general, or risk parameters through a CVAR constraints on a theme level. So let's say, and I think I have a good actually. Oh no, I don't have it here in this presentation. But essentially, let's say what we call this first theme that I said, the U.S. equities. For instance, that's what we call the maturing expansion here in the U.S. So that's where we put allocate most of our positions in the short end here in the U.S. And then we try to stay within our constraints of a CVAR, and how much ideally we would be down on a daily basis of those positions depending on the day. So it's that has been one way of managing risk, but obviously understanding the future correlations of asset classes that we own in the portfolio is another huge part, and which ones are the ones that are likely to act as more of a hedge, which I'm happy to elaborate more on that if you would like me to.
You're the captain.
Okay, so one thing we've seen in the markets today that has been an important development, and I've been talking about this for a while now, is that inversions in the yield curve are extremely important, and they have been credit markets have been acting as a bellwether for stocks for a long period of time. And one way we looked at this at Crascat Capital is just calculating the percentage of inversions in the yield curve today. This chart is actually not updated, but as of yesterday, for instance, and I would love to open this file as soon as in an hour or so here. But I know that this number is even risen now. It's probably close to 75% of the yield curve today is inverted in the U.S., which is just as high as it was at the peak of the housing bubble and the tech bubble as well. So, when you think about inversions in general, yes, they're negative for the economy. But one of the things that tends to happen here is that if you go back to this chart initially here, which is inversions versus gold to the S&P 500 ratio. So the third chart there in this panel, or the third panel of this chart, you can see that relationship. And I think gold is really the best hedge of our shorts in the U.S. equities here, given how central banks are likely to provide even more liquidity going forward here to try to boost the economy in general. Maybe through another form of QE, but right now we're seeing through rate cuts. And it's hard to see a scenario in which the business cycle doesn't turn completely without having a very large intervention by central banks, which I'm a truly believer that I truly believe that there's no way a central bank can can prevent a business cycle from turning. I think that's another one of those. It's going to be different this time. Type of stories. So
they can delay it though, right?
They can delay, and that's the whole point of holding gold and versus S&P 500 ratio, which tends to do really well during periods like that. So as they start to really signal a more dovish stance in the following months or so, I mean, you should start seeing precious metals rise, and it's exactly what we've seen. Being, and at some point, this kind of nonsense belief that on equity markets in general, it starts to fade away, and then that's really when this ratio starts to rise even further. Those ratios starts sometimes, it's the driver recently has been gold, but the driver of this could be stocks, as we've seen in other recessions. In other words, is stocks falling. So, and there's so many issues in the market today that could, you can easily come out with a very reasonable thesis of why you should be shorting stocks today.
How do you hold gold? Through the ETF GLD, through mining shares, through physical? How do you allocate a certain amount of equity to gold? In what form?
Yeah, so in order to stay in that CVAR constraint, we have to hold a very large position of gold itself, or in the futures, markets. And so that's been a large one, a large part of it. And then the other part would be another significant position on silver, also on the futures market. And then the third one would be a basket of mining stocks. The mining stocks have been in a bear market for about since 2011 or so, and some of those stocks are down like 80% from their peak. So it's a very interesting industry that we're very focused, especially on the first part of this move here in precious metals are likely to be, especially in the mining stocks. In our view, are going to the ones that are going to benefit from that are going to be the ones that have a very low EV to reserves. And that's the ones that we're focusing the most. They're the ones that are likely to be acquired by some companies, and also the ones that really hold those wonderful assets, for very cheap values. And a lot of them are trading below that EV. The reserves are valued higher.
Can you define EV for our listeners, viewers?
Enterprise value.
Okay.
Yeah, sorry.
All right. And do you have a view on the gold-silver ratio, which recently has been as high as 93, now trading mid to upper 80s? Do you think there's going to be a reversion to the mean trade between gold and silver?
Yes, I do. And we hold in the portfolio as much silver as we can within our risk. But yeah, I firmly believe that that's the case. I think I've shown a very interesting chart of silver before. I don't think it's in this presentation. Silver versus Russell 3000 relationship, which is, or actually Russell 3000 versus silver, and it kind of formed this double top recently, with kind of retesting the 2000 insane valuation levels for stocks. It's just another way of looking at silver, how it has been historically depressed prices in general of silver. But silver is an interesting one because the first leg of the bull market in precious metals, and maybe the second too as well, is where silver can do really well. But you have to watch out, because if there is a truly a recession coming here, and the economy really turns south, not just in the US but globally, silver, as being a more industrial commodity, could definitely take a hit here in the following months too. But we still think that that's in the early developments of that. So we're still holding silver in a big way, and I do think that the silver to gold ratio, or the gold to silver ratio, is likely to drop significantly, maybe retest the medium levels. Yes.
Where would that be in your work?
Well, I don't have the ratio here in front of me right now. I actually
guesstimate.
Gosh, I don't want to estimate on that, because that's not a big
okay.
Of our. I'd rather estimate on the gold to S&P 500 ratio. For the next 2 to 3 years, I think that's reasonably reasonable. That we're probably going to go at least double that ratio. And if that happens, obviously, I think silver, especially in the beginning of that move, is going to have a huge move to, or a huge advantage to that whole market development. So it's just we have silver, we have gold. We're not necessarily focusing on that ratio. We're focusing more on the precious metals to stocks ratio than anything else, just because it's it's a more way. I think it's the right way of finding a true defensive strategy for anyone's portfolio, in our view, at least.
Okay. Next.
So, another way of looking at precious metals is, this is actually was made by Increment and AG. It's one of the few charts here. They're not mine, but this is an incredible chart, and actually goes back a lot further. If you wanted to, it goes back to 1929, which shows how commodities to the S&P 500 ratio have been depressed for a long, long time, and this imbalance is really when it turns, and a lot of times is due to a commodities move, and other times is due to the equities part of it. We think it's going to be both this time, and just like was a tech bust and the Nifty 50 in 1972, and meaning that stocks are likely to drop significantly as the entire precious metal space should probably rise. But there are so many ways you can see that, especially on the nominal rates that create this great environment for precious metals. If you look at the 2-year or just nominal rates, 2-year yields all the way back to the 70s, and you connect the tops of the 2-year yields, and you start to see that you hit this resistance line and start dropping significantly, you're at the peak of a cycle. Very clearly there in this chart. It's probably a must watch, and everyone monitors, and not a lot of people pay attention to this. But if you believe that the 2-year yields are going to drop significantly, as I do, you would think that the real yields would also drop significantly. This is just looking at the relationship of real yields inverted on the blue line, and then the gold line is gold. So you can see very clearly that those two follow each other remarkably close. And if you're likely to see nominal yields dropping, real yields should drop. And in an inverted version, you would expect gold to follow on the upside here. So that's a major part of our gold thesis as well. Aside from just the levels of leverage, which shows here in this chart, the huge amounts of and this is not like more of a short-term way of looking at markets in general. This is more of a big macro picture of what's happening globally. Very clearly, you can see here that when you look at total debt to GDP ratios of the past largest credit bubbles we've had, all the way back to the 1990s, and the Asian crises, and the housing bubble, even in the European debt crisis, you can see very clearly that when you look at the average of the total debt to GDP ratio, we're somewhere close to 245%. Today, if you look at the top total debt to GDP ratios today, that average is significantly higher than that historical average. So, that's clearly an imbalance. And honestly, that's a huge part for why we think gold is likely to perform well, not just and perhaps will be a secular shift here for gold in general, which I think that there's no way all this money printing and amount of leverage we had in the system will have to translate into inflation at some point, and at least a value destruction of fiat currencies. And so but that's more of a big macro picture. The reason why you want to be long gold today is a lot more because of the today's macro imbalances that we're seeing. But here is I'm going to go back to the beginning of the presentation as I skipped a ton of it. But China is the second largest theme in our portfolio, which we think that China is a historic credit bubble, and probably the way that things are going to play out is that the yuan is likely to devalue. We even have another kind of what we call the currency crisis, is when the equity market declines along with the currency market. And that's kind of what we saw in Argentina the other day, and it's what we see in a lot of other credit busts historically. But One thing that tends to happen here is that gold in local currency terms tends to do really well during credit bust. And one of our major positions in portfolio today is being long gold in renminbi terms. I think that that's probably I understand it's a more sophisticated type of investment, and not a lot of people are able to do it. I need it is the agreement and blah blah blah, but the idea being, if China really is this huge historic bubble in terms of its credit imbalances, you would expect that an implosion would cause the price of precious metals in local currency terms to rise, just like we saw in Turkey, like we saw in Brazil, in Argentina, in any place that blew up significantly. Tends to happen, especially emerging markets. That's a very important.
Would you say China's a little bit more prepared for it than the other countries you mentioned, since they've been the biggest buyer of gold on the planet?
Sure. I mean, that's just driving gold higher in their local currency terms, right? So that doesn't mean necessarily they're being prepared. They're massively short the dollar, and I think that's going to be the problem. I think that's a $45 trillion banking system can never be fully prepared for a credit bust. That's for me, that's the bottom line. I've never seen a country that had that much leverage in the system. That's just on balance sheet assets. I mean, if you include off balance sheet, you're talking about another $40 trillion of assets. So I don't think that that's going to unwind. There's not going to be a soft landing scenario here, in my opinion.
Okay, so let me ask you, do you have any kind of levels? We recently cracked the 7 level in US dollar yuan. Do you think we could go to 8 or 9 or?
I do think that it's usually in average this imbalances tend to when they occur, as I said, you don't know which one it plays out. Is it the currency or the equity market? In this case, we're playing both. Because it's so easy to get an option on or play on the derivative sides of the currency itself, meaning the CNH or the Hong Kong dollar. So I think that it's plausible to come up with at least a 30% devaluation of the yuan in order to come back to more normal levels in terms of, especially of its M2 money supply versus its GDP. As we've shown before, the way we value the currency. But
do you short Chinese stocks because of this? How are you going to take advantage of China's blow up because of credit and debt to GDP?
So a large part is being
gold
on the currency side. A large part is being being long gold in renminbi terms, and the third part is being short the most overvalued companies in China. When I say that, I'm not talking about the A shares that are trading at low levels, supposedly according to their fundamentals that have been reported. I'm talking about things like the ones that had IPOs in the U.S., like the Alibabas of the world, that are extremely overvalued. And it's just if you agree in that term that we're going to have a credit bust in China, there's no way those companies are going to be valued where they are today. So that's really our view, and that's the third part is being short the Hong Kong dollar. I mean, it's the cheapest trade you can find. Well,
because that peg is held forever till the last month or so, right?
Well, it's still pegged, and you're right. It's being held forever. Like in the Asian crisis, for instance, that peg they never depegged, even though they had a credit bust. So what happened there was very clearly the equity market took the pain, and I believe Hong Kong stocks in average were down close to 60% or so during that period. So yeah, that was a very important part of playing that. So that's why if you can find leverage to not get killed on one of those 3 positions, let's say on the China credit bust, let's say you don't get killed on equity markets going a lot higher, and that kind of offsets your gains on unfortunately on your currency play. I think that's the key, and I think we're that's where the derivatives part of it plays a big part of how to position those in the portfolio. But so far
talking about getting killed, do you think that mainland China is they're massing troops, they're going to go into Hong Kong and pull a Tiananmen Square in Hong Kong?
I think, as a money manager, I'm just looking at the probability of those things happening. I think the probability of that is very high. And
what if they do that? Then Taiwan is next.
It could be. Taiwan is hard to focus on because of there's not as much liquidity as even places like Hong Kong. But what could happen is obviously the depeg of the Hong Kong dollar and things like how do you sustain, like I was looking at just a secondary residential market in Hong Kong, which is not even the primary one. So, you're looking at 1,700 square feet, $1,700 per square feet valuations of real estate there. How do you sustain that? There's no way. And there's another part that is important too. Well, Hong Kong.
They should sell and move to a ghost city in China.
Yeah.
And they'd have no neighbors. It'd be very quiet, right, Tavi?
That's right. But what's interesting about this too is that when you look at the banks in Hong Kong, and the amount of provisions of loan losses they're doing, their allowances on the income statement today as being, compared to, relative to the revenues. So let's just call it, I don't want to pick on one or two banks, but you can easily find banks, the largest banks in Hong Kong. I'm talking about the top four, that are provisioning close to like less than 4% of the revenues on loan losses. Do you know how much they used to do back in, not even in 08, just 06 and 07? Those things.
20?
20 to 30%. When, that's.
They have no coverage now, do they? They're weak.
No, it's just, when those losses come, it's going to be ugly. So, the political crisis, what you ask about, will China really, possibly relent or really force themselves into a real political issue here in the following weeks? I think that the political power trumps the economic power, especially when you have a authoritarian and communist regime, and that's the case in China. So, obviously they will try to hold their political power as best as they can, regardless if that means that economic conditions, deteriorate caused by that. And obviously that's not a perfect scenario. I'm sure they're not.
But they're used to it.
Yeah, they're used to it.
Their population has gone through so much over the last 70 years as far as cultural revolution, etc., starvation, everything. So, you really want China to be your friend. If you don't believe that, ask MacArthur. So I have this question. As an RIA, what's the minimum amount of capital that your company accepts for your to manage an account, or are they funds? How do people get involved with you, Tavi?
Sure. So there are a few ways of doing that. Getting in contact, we have a website, crescat.net, or you can also get, on Twitter. You can message me on Twitter. I have an open message, so anybody can message me and talk about that. But what are the ways is, a person, if they're a accredited investor, minimum investment is $250K on the hedge funds. But we also we opened this other strategy, which is we've had the large cap strategy for a long time, which is a separate management account. So there's no minimum there, pretty much. There is a minimum there, but there's no minimum almost on. You
don't have to be accredited investor to be in that.
That's my point. But also, if you're in the precious metal account, which we open now as well, a separate strategy as well for just precious metals, mining stocks. In there, that idea was that we could at least be able to raise capital of people that are not accredited investors yet, and maybe help them together. So on that you can invest as much as 20 grand. So it's actually very not too difficult to be an investor of Crescat today. So it's fairly.
So don't wait to buy gold. Buy gold and wait, right, Tavi?
That's a good quote. I
I
like
got
that.
1 million of them. Anyway, Tavi, it really was a pleasure meeting you. It's interesting to hear an RIA hedge fund guy, that has these kind of strategies that looking at the glass being half empty, because it is, not because you're pessimistic, but you're just looking at what you see, and encourage people to follow your writings, follow you on Twitter, and you're now my trading warrior brother, Tavi.
Oh, thank you very much. I appreciate you having me. And if anything, I just want to say I'm not a perma bear, like you said. I think it's reasonable to have that thesis today, given all this macro imbalances we're seeing. Just really a line of them. I mean, there's way too many that it's hard to ignore and just be long equities and trying to take the less juice of this market. So I fully. I agree with you there. So thank you for having me as well. And I hope
you're very welcome. And may your returns expand and outperform the S&P tenfold. How about that, buddy?
Thank you. I appreciate it. You as well.
All right. Thank you very much, everyone. So you could follow Tavi on Twitter. Here, I'll show his handle. Okay. His handle is right here. Come on. Okay. At Tavi Costa. At TAVI COSTA, and he has a link to his website there. So that's a wrap, everyone. Remember, don't just count your gold coins, count your blessings, and we'll see everyone tomorrow. Good hunting. Adios. And really appreciate Tavi taking time out of his day to be with us.
Thank you, Dale. Appreciate it.
All right, take it easy, buddy.
Bye.
That's a wrap. See everyone tomorrow. Adios.